Hi, this is Roger Hutchison with InvestingDad.com, and today we're going to talk a little bit about options during the expiration week. This is the third week of the month. Actually, it'll be the third Friday of the month, which is when options expire. And so there's some strategies that we can use to take advantage of that that are probably best used during this final week. They're called credit spreads, and you essentially sell one side of a credit, or one side of or you sell an option that is near the money, which is means that if a stock is worth $100, you sell a 105, and then you buy back a 110 options for those, and then you get to keep the difference. I'll show some examples here in a second. What makes it difficult right now to do that, normally it's a pretty safe, pretty reliable way to make a little bit of money in the short term. Because you can do these kind of trades the day before or even the day of expiration. So what makes it difficult this week is, of course, the world financial thing with all the credit being stuck and world governments getting involved in companies and banks and all that stuff. So it makes it very much less predictable. Makes it much less predictable than it normally is. So what do? Well, you just keep an eye on things. There's a couple of things I was looking at over the weekend, and one of them, Goldman Sachs, which of course is a bank, and normally I just kind of want to stay away from that, but it's kind of an interesting example because it's not making huge swings that you would expect with people actually getting directly involved with it. People outside the company, I should say. Governments kind of involved in the whole sector. But it's kind of interesting to look at. So you can actually see that between the strike prices, say Goldman Sachs is going down right now on the chart. It shows about $105. If you think it's going to continue to trend down, I'm actually more comfortable with, if I was going to do that right now, today, I'd probably go with my closest to the actual underlying stock price. I'd probably go with the strike price of $120 and go with the next out of the money option at $125. And then you can see that with the bid price, you would sell at the bid price, and you buy at the ask price, and then you get to keep the difference as a credit. And as long as the options expire, if Goldman Sachs hasn't gone into the money, hasn't gone into the $120 range, then you get to keep the difference. So you don't it's not a huge return on investment, but it's something, which is a lot more than other people are doing in this kind of market. So anyway, that's an idea. That's one way to go about it. Hope that was helpful, and hope you have a great week.